Hello, good afternoon. My name is Mitch Ackles. I'm the president of the Hedge Fund Association. I would like to welcome you to the HFA webinar, LIBOR Transition. For those of you that are joining us today, thank you for taking the time. As you know, LIBOR is the globally accepted key benchmark interest rate, and it's going to be phased out by the end of 2021. And HFA is very proud to be working with our thought leader, Citrin Cooperman, to bring you this program today along with our panelists. So before we get moving, I would like to give you an overview of the Hedge Fund Association. So the Hedge Fund Association is a global nonprofit and nonpartisan trade organization. We focus on uniting our members, and we do so by delivering content, by producing events like this one. And we certainly invite you, I'm not going to go over these slide bullets in detail, but we invite you to follow the links if you are not already a member that you've received about HFA and consider joining. And I'd like to thank Alex Reyes, who is my fellow HFA board member, our regional chapter director for New York, and part of the thought leadership that Citrin Cooperman, our sponsor for today's webinar, has facilitated for HFA. So thank you very much, Citrin Cooperman. Thank you to our speakers. And now I'm going to turn the call over to Alex Reyes. Please take it away, Alex.
Hey, thank you, Mitch, and welcome everyone. It's a pleasure to once again team up with HFA on today's very important topic on this transition from LIBOR. After the panel, we'll open it up to some audience questions, so feel free to submit any questions during the program using Zoom. Now it's my honor to introduce outstanding panelists. I'll start with Michael Burgess, principal with Cleareye Services Group, Mariya George, President and Chief Revenue Officer with Cleareye, and David Wagner, Senior Advisor with Houlihan Lokey. So thank you to each of the panelists for joining us today. So let's get started. So I want to start with you, David. What is LIBOR and what is the LIBOR panel?
Well, thanks, Alex. The LIBOR is one of the phrases that I've heard to describe LIBOR is the world's most important number, because it is everywhere. It's a ubiquitous, pervasive, and now terminal number. So about 50 years ago, a banker called Minos Zambonakis needed a standard cost of fund index that he could use for banks in various jurisdictions across the world, essentially for oil-based transactions. And in developing this cost of funds index, he decided that all these banks were represented in London, so they should simply get together every day and essentially tell each other where they were borrowing money and establish that rate as their cost of funds rates for banks. So the concept of a London interbank offered rate, it came into being. So, and that was really 50 years ago now. And the reason it was London-based and not US-based is that the London market represented all of the offshore dollars that were no longer part of the US dollar banking system. And it needed a rate. There were rates in the US, you could have treasury rates or Fed funds rates, any of those other things, but it needed a floating rate. And so establishing it as a cost of funds rate that you could use globally in different tenors as a standardized unit to facilitate international syndicated lending was the idea that Minos had, and it worked quite nicely. So for 50 years, we've been using this LIBOR rate. It developed, and when I say developed, it grew beyond the use of just an interbank rate and for loans. In the 90s, the exchanges in the US and in London that were doing futures standardized the deliverable of a futures contract on the Eurodollar rate. And the reason it's called Eurodollars is because, as I said before, it's the dollars which are outside the US banking system in Europe, in London, in those banks, and it's a cost of funds index that was represented globally. So for 50 years then, as we grew the loan markets, the futures markets and then the derivatives markets became, and the phrase a LIBOR swap is also ubiquitous. LIBOR became embedded in every part of the financial system, but it was still a rate which was set by banks talking to each other every day in London. It represented transactions on days they did them, and maybe not so much on days that they didn't do them, but it was a cost of funds rate that was used for that 50 years. And it worked really nicely, I guess, is one way to look at it. It worked really nicely for the banks, particularly in this idea of facilitating loan markets. But it started to become a little bit more than just a floating rate. It became a proxy for AA credit, because again, we're loaning between banks, and not just for a single night, but for long tenors. Some of the LIBOR tenors go out for a full year. So LIBOR itself at one point became a proxy for AA credit, the place that strong banks would lend to each other. So it was an overnight rate, facilitated bank lending, became a AA credit rate, and was embedded in almost every corner of the financial markets. That's basically what LIBOR is. And so even today, and I think we have a slide of the panel that submits LIBOR. LIBOR is no longer, I used to tell my children that LIBOR was a number that was aggregated by a bunch of bankers sitting in their stuffy club room in London in leather chairs at 11 o'clock every morning, which may have been true at one point. But the British Bankers Association used to set LIBOR. It's now set by a much more rigorous process, which is owned by the Intercontinental Exchange and regulated by UK's FCA. And this is the list of panel banks who regularly submit LIBOR quotes in multiple currencies and multiple tenors to the ICE, who does a calculation on it and publishes a grid of LIBOR rates in tenors and currencies. So that's where LIBOR is, where it came from, and what it's been doing for 50 years.
And thank you, David. And Michael, why does it have to change? Why don't you kind of walk us through that?
That's an excellent question. So LIBOR, as David described, is a metric that's put together in London, and it always used to be a bit of a clubby atmosphere. It was in the lead up to 11 o'clock every day. The panel banks would submit their expectations of what they would pay to borrow along the curve to the British Bankers Association. And the problem came as we got to, in the lead up to the crisis, and especially after the crisis, interbank lending really stopped being the basis that banks were using for funding themselves. And so that market became really very thin. And the reason was because what you would do instead is you would borrow from the central bank. So you would take your positions that you had as your trading positions overnight, and you would then lend them on a secured basis to the central bank, and the central bank would give you funding. So your cost of funds actually weren't the same as the interbank lending. As a result, as that market got thinner, then it became harder and harder to rely on actual observable data to be able to set LIBOR. And then when the financial crisis hit, it was almost impossible to say what the interbank lending price was, because nobody was lending, because it was a liquidity crisis. So you had a thin market, and then that gave you the opportunity to say, well, if I'm not relying on observable data and I'm really being theoretical in terms of what my rate is, I'm just kind of making it up. And then it became open to abuse. And there were some pretty serious scenarios that took place through the period before the financial crisis and immediately afterwards, where actually there was open manipulation of LIBOR rate. And it started with those who were holding interest rate derivatives in the trading desks, kind of talking to their treasury divisions to say, hey, when the BBA call you at 10:55, can you just tell them that the rate didn't go up, or can you tell them it went down a bit? And then it got as far as, calling your friends over at UBS and saying, hey, when the BBA called you, can you also say the rate doesn't go up or down? And it became so bad that you're in the scenario that you've got this number that there's $350 trillion worth of derivatives that follow US dollar LIBOR, all subject to a group of 11 or 12 people who are talking and setting the rate amongst themselves. So the Financial Conduct Authority, as it is now, or what was then the PRA, then said, listen, this has to stop. Okay, we've got to move to something that is only based on data, that can't be manipulated, and isn't dependent on this group of banks who actually don't want to publish the number, and because they feel like there's a lot of liability attached to that number now. So the FCA started off saying, well, since we regulate the conduct around publishing LIBOR, we're not going to compel banks to publish LIBOR after a given period. And let's say, for the sake of argument, that was the end of 2019. That's since been pushed out now to be the end of 2021. But actually, you're in that scenario now that you say you can't continue with LIBOR just because it's open to manipulation and too much depends on it. As a result, alternate rate reference committees were set up for each jurisdiction. And those alternate rate reference committees, or in the US, the ARC, have been working on what was initially an alternate rate that you could use instead, and has since been called up as a replacement rate, or replacement reference rate.
Okay. Well, thank you, Michael. And so now we understand, what LIBOR is. We understand why it might need to change. Maybe, David, can you share a little bit about the timeline, whether you think it'll be delayed? Talk to us about that.
Sure. So, and I'll just give you one or two little personal interjections as well. When you saw that graph earlier, I think the third bank on the list was RBS. I was an employee of RBS during that time. Had nothing to do with LIBOR, but the $1 billion fine that RBS paid echoed through the organization, and the conduct risk issues and the compliance thresholds became staggeringly important because the bank recognized that although it was a small group of people with some bad conduct, it could echo dramatically through not just the financial organization, but through the bank, and cost a huge amount of money. So I've been intimately involved in LIBOR, both as a derivatives practitioner and in the post-fine environment of LIBOR. And I agree completely with Michael. The banks very much would like to get out of the requirement to submit a LIBOR rate. So in that environment, and again, I'll give you one other personal anecdote. Well, first let me define. Michael defined the alternative reference rate committees around the world. And in the US, yes, the Fed established the ARC, so Alternative Reference Rate Committee. And in the beginning, in 2015, when it first operated, it was an alternative rate, not a replacement rate. So that's 2015. By 2017, the FCA, the UK's Financial Conduct Authority, made an announcement which was consistent with the EU benchmark law that said, that it essentially said, we recognize that the EU benchmark law says that we can only compel banks to submit for another 2 years. So that was in 2017. The FCA said we can only force these banks to do something they don't want to do for 2 more years. But they knew that although we were looking at alternative rates, nobody had really thought about a full all-out replacement in the market. It would be, after all, the world's largest voluntary market structure change ever. So we looked at this and they said, well, we're going to need more than 2 years. So they already negotiated with the banks to continue to submit to LIBOR beyond 2019, which would have been the benchmark law's requirement maximum date. And they said, we won't compel you to submit after the end of 2021. So when we talk about LIBOR going away, it's important to understand that LIBOR doesn't die because a regulator will pull the plug. LIBOR will go away because the banks who are submitting it desperately want to stop submitting it. And the regulators recognize that that would be a financial crisis, a financial stability issue. And so they have negotiated that to use their regulatory powers to continue to compel the banks to submit until the end of 2021. So it goes away because the banks want to stop submitting, but it stays that long because the regulators have already negotiated that timetable. And you can see here on the screen that in 2020, there have been a significant number of events in the market. And when I say in the market, it's the group of people who are both regulators, international organizations that have oversight around stability, like the Financial Stability Oversight Council. It's all of the industry boards that are global, and in the U.S. we talk about ISDA, the LSTA, the Structured Finance Industry Group, the CRE, the Commercial Real Estate Organization. They all have input through their members to what this process is going to be, and all of these, the non-governmental organizations, governmental, and industry associations have all contributed through the ARC's organizational framework to moving this process along. And although in my regular work, I still see a lot of people who ask me this question, will it really go away at the end of 2021? And part of what we've just spent the last 13, 14 minutes talking about is to give you some background that it's really not going to go away, because this timeline is, there's been lots going on in the background, and there's a lot of forces around this end of 2021 date that aren't going to change. So that gives you an idea of an overall timeline. I should probably mention, though, that things really got busy in 2020 and maybe in the background. We had a few events just recently that had been planned for a long time. The exchanges moved from a discounting curve of Fed funds to a discounting curve of SOFR. And I think we should define, maybe I'll just define right now, that the replacement rate in the US has been chosen by the ARC and is intended to be SOFR, the Secured Overnight Funding Rate. We'll talk about that more probably. But the discounting rate has been changed at the exchanges. The ISDA has put out a protocol and supplement to change the way derivatives works. And the loan markets have also put standardized contract out to look at the way that loans are calculated, all in preparation for new issuance across all asset classes using this replacement reference rate.
Okay. Thanks, David. And you kind of, stole my thunder. Next question here is, let's talk about SOFR, and what we're going to be using instead, and maybe some of the differences between SOFR and LIBOR. Maybe you can walk us through that. That'd be helpful, I think. Yeah, no, you're absolutely right, because it is people say, well, why can't we just, it's a number. LIBOR is a number. Why can't we just take another number and stick it in wherever LIBOR appeared? And I will say, I was on the ARC from its inception in November of 2014 was its first sort of general meeting. And for almost 2 years, as new members came into the ARC, they asked exactly that question. It's just a number. Why can't we just pick a new number and stick it in all the contracts where LIBOR went? And I think it's instructive to look at how each of these rates are built and then their differences, because it is from those differences that really all of the issues around this transition are a result of all these differences. So let's go through SOFR. And again, that's the Secured Overnight Funding Rate. And that's versus LIBOR, which was the London Interbank Offered Rate. And just in those words, you can start to see some differences. But if I start with secured means that the transactions that we observe to get these rates are repo transactions. Repurchase agreements are secured by treasuries, similar to the way that Michael described it before, right? You offer the collateral of a treasury and you receive cash overnight, and that's how you fund yourself. So these repo transactions overnight form the basis of the rate calculations, and they're reported reliably through both clearinghouses and tri-party custodians into the Fed. So LIBOR, on the other hand, as we talked about before, it's a rate set by experts at 11 a.m. in a market which is not the domestic US dollar market. So it's for offshore deposits for US dollars in a wholesale format. So the secured nature eliminates that AA credit spread that we talked about at one point. But if I keep walking through this list, I mentioned that the Federal Reserve established the ARC. Well, the ARC also asked the Federal Reserve to administer and publish and calculate SOFR. The ARC said, if we're going to have a robust reference rate, it shouldn't be, no one should have a profit motive around it. It should be published by essentially the government, and the Federal Reserve is the obvious candidate for that. LIBOR, on the other hand, is actually an index
which is owned by the Intercontinental Exchange, and they have a profit motive for keeping LIBOR operating. It's only regulated by UK's Financial Conduct Authority. So that structure in itself makes the end of LIBOR look a little different than one that would be simply switched on or off by a government authority. SOFR is an overnight rate. And this starts to get to the heart of some of these fundamental differences that cause the problem. As SOFR is only for one day. It's the transactions that occur on an overnight basis. You're very familiar if you've got a loan or if you have a security with the idea that I have 30-day LIBOR or 90-day LIBOR or even longer, 6-month or 1-year LIBOR. Those multiple tenors are all available in LIBOR and submitted on a regular basis, and each one has a unique rate. But in SOFR, there's only a single rate. It's a single overnight rate. That, however, is a function of needing to be IOSCO compliant. So IOSCO is an international standards organization, and they said that, well, you have to have transactions that you observe to get this rate. So as the ARC met and discussed the various possibilities, we looked at SOFR and said, we looked at the repo market and said there's $1 trillion in daily transactions in the repo market. It is the most robust and most broadly participated money market in the United States. It's where all of the overnight cash sits, whether it's your personal money market account or bank cash or corporate cash, and it is then secured every night to prevent any credit risk, and the availability of that cash is a reflection then of market demand for money and a perfect rate. LIBOR, on the other hand, is not IOSCO compliant these days, and Michael referred to this fact that the markets had changed and there really weren't sufficient market transactions to base your quotes off of all the time. So it's no longer in some tenors an IOSCO compliant rate, and it's been evidenced that it was subject to manipulation. When I look then at the requirements for using this index in all of the ways that it's been used, LIBOR, and you can see in the bottom, has Eurodollar futures and cleared swaps. And they're the backbone of the hedging and rate speculation market. SOFR developed those same instruments. So we now have SOFR futures and we have cleared swaps. And I'll use this acronym and we might talk about it a little bit later, but OIS indicates that it is an overnight indexed swap. Currently, there are OIS swaps, which don't use SOFR, but they'll use the Fed funds rate. The Federal Reserve did not want to use the Fed funds rate, which is essentially for them a policy rate, to be the standard rate in the US. So, our new rate, SOFR, although it closely tracks Fed funds, we had to migrate all of the overnight index swaps and develop a new swap market, which was based on SOFR, but in an overnight format, not in a tenor format again. We don't have the equivalent of a 30-day SOFR or a 90-day SOFR. There's only overnight SOFR. So you can start to see that these differences are going to create a bunch of issues, problems, and questions at borrowers, lenders, systems, and that multiplies from there.
Okay. Well, I mean, we've heard a lot of the advantages of SOFR and over LIBOR and why some may want to move to that, why we are moving to that. But, you know, this next question, I think, goes to both Michael and David. You know, what's wrong with SOFR, right? What are the disadvantages? We talked about some of the advantages. Let's kind of go on the other side and talk about maybe what's wrong with SOFR. And maybe we start with you, Michael, or? Yeah,
so I'll take that one first. The first thing about it is when you move to SOFR, you're really looking at something that's very US specific. The SOFR rate being an overnight index, being an overnight secured rate, it tends to track the Fed funds rate. So it's very similar to the Fed funds rate, which is the rate at which banks can access funds by borrowing from the Federal Reserve. And that's effectively what you're doing with your SOFR swaps is you're actually borrowing from the Fed using treasuries as collateral. If you're a US domestic bank, that's probably reflective of your current sources of funds. And so therefore, it is something you can use for pricing and it is something you can use for running your business. And Treasury can put that into your transfer pricing curve and charge your businesses accordingly. But if you're not a US domestic bank, which when you think about it is the vast majority of users of LIBOR in derivative contracts and in international dollar lending, then SOFR is much less relevant to you. And when we're talking to our international clients, particularly those in Europe who don't have a US retail presence, then they have a lot of trouble with SOFR. It's not something that they have a lot of reference to. It isn't really relevant to their funding profile. And so as a result, now they're starting to think about, well, what can we do alternatively? And that's where SOFR is the accepted alternate, has a couple of things that are springing up as potential alternatives. And I see there's a Q&A that talks about this that we can, well, there's a question that's been asked, which we can talk about later, which is, you know, there's another type of IBOR called an Ameribor that looks like it's being put together to try and compete. The problem with that is it's still IOSCO compliant? Is it still something we can live with? But the biggest problem is, well, it's fine for US domestic. It's not that great for everyone else around. And so it means that if you're out there trying to work out what my alternative is, and especially if you're in the hedge fund industry and you're saying, how am I going to actually achieve my investment thesis if LIBOR goes away, then you're in a position where well, actually SOFR might not solve that problem. David, I think you can talk a little bit better to the components of LIBOR that are there now that won't be there in SOFR.
Right. So let's advance the slide one, and let me move a little bit to a little more technical discussion about SOFR and LIBOR. The slide you're looking at comes from Bloomberg, and it's fairly recent. It's through September, and it shows the daily observations of SOFR and 90-day LIBOR. So if I look at the top part of the graphic, there's a green line and a white line. The green line is the daily SOFR rate, which is of course a daily rate. And the green line on top is the daily rate of 90-day LIBOR. So these two rates, you would expect to roughly track each other. But we've had a very interesting period. In September of last year, there was a little bit of a hiccup in the repo market. And at the beginning part of this diagram, you can see a big spike in SOFR's rate for a few days. And in the bottom part of that diagram, where it measures just the difference, you can see that spike was a big number, something like 300 basis points, but only for a couple of days. And we moved along then with a relatively constant relationship for quite some time, of course, until the pandemic hits. So at that point, liquidity measures became very, very prominent. And SOFR, again, being that instant response daily rate, dropped. LIBOR also dropped, but then very interestingly bounced back up. And since it is a 90-day rate, that reflects the expectations of people of what was going to happen in the liquidity markets over the next 90 days. And it also reflects what was supposed to be the funding needs and rates that banks would use to fund themselves. So you can see that the psychology or the design of these two markets moved very differently. LIBOR moved because it was the rate that banks said, well, if I was going to fund, where would I fund? Where the repo market instantly reacted to the flood of liquidity that came out, and it fell like a stone. So in the diagram below, then you can see that this difference now in the other direction was big, is sort of 100 and something basis points, 100 to 150 basis points different, and it persisted for quite some time. So where you would think about in normal operating environments, you would have a fairly constant difference between these numbers. In fact, in the last year, which has really been SOFR's existence, it's had quite a turbulent environment. But this market observation isn't enough to facilitate the transition. And when I say that, what I want everyone to think about is, all right, on the day LIBOR ceases, the day it's not available on the screen anymore, what do I do? What do I use? And the answer is going to be all of your contracts should have been prepared to move to SOFR. However, you're going to say to me, well, I'm looking at your screen here, at your slide on the screen, and I see that LIBOR is 15 basis points different right now from SOFR. So how are we going to make up that difference? And ISDA and the LSTA and ARC have all thought about that difference and how you're going to get some rough equivalency between LIBOR and SOFR. And the formula that is now standard in most of the recommendations is that the ISDA will observe for the last 5 years the daily difference between overnight SOFR and 90-day LIBOR, just like the graphic that you see here, except for 5 years rather than 1 year. And it will take the median of that 5 years and carve that number in stone to be used for every SOFR which replaces a LIBOR forever going forward. So that number will become static and permanent. The number is available. It's published by Bloomberg as the index provider. It will be final the day LIBOR goes away, but it is already being published from the current previous 5 year. And that number today is approximately 26 basis points. So if you have a LIBOR contract and you have provided for SOFR to be your replacement rate, it's most likely that in order to achieve the rough equivalency of value when you move from a LIBOR reference to a SOFR reference, that you will use this 26 basis points, and your new payment coupon will no longer be LIBOR, but will be SOFR plus 26. And it won't only be SOFR, it will be the average or the compounded SOFR resulting from observing it every day through your payment period. And if the payment period is 30 days, it's 30 daily observations. If it's 90 days, it's 90 daily observations. So you can see that as I'm talking, the complexity, the operational complexities start to grow between how you implement SOFR and make it operational in your systems and how LIBOR operated. And that's, I guess that's the downside, right? The question is, what's the downside? That's one of the downsides, is operational complexities.
Yeah, and I guess it's clear that there's a lot of moving parts. There's a lot to consider. So I guess, Michael, what does a project look like, right, when you have when this is impacting you?
So the first thing to do is that risk analysis, right? What is our problem here? Okay, so LIBOR goes away. That's great. What we tend to see is you have somebody central who owns the project, and centrally that's going to be most likely somebody who has a treasury function, usually joint together with the CFO or the COO for the organization, because you've got operational elements as well. And you stand up your project, with each of the division heads for your business units as part of the steering committee. And you make sure that everyone is aware, wait, this is a massive change to the way financial markets are going to work. We need to turn over every rock here to see what the implications are. Then you kind of break that up into three functions next. Okay, where is our exposure? So that's a risk assessment. What needs to change, which is a change or a transition assessment. And then how do we tell everyone about it? Where is our exposure is where most people are at the moment that are on the buy side. On the sell side, they've moved a little bit further along. But on the buy side, where we tend to be is, well, we're still looking at what we have. And the biggest point that's a sticking point at the moment is around legal contracts. And the reason is because if you have a standard loan agreement, and that loan agreement says that you have you will pay interest on a floating rate basis, and that floating rate will be set according to LIBOR, and it'll be LIBOR plus a spread. Then you have to say, well, if there's no LIBOR, what happens in this contract? In most cases, you will define if LIBOR is not available, then what happens? And that's where it falls back. If no LIBOR, then you fall back to something else. That concept of fallback language is what's causing the legal divisions in the whole asset management and finance industry to do headstands at the moment, because actually you have to go through every single contract. And you have to do a risk assessment to say, well, what's going to happen in this contract when LIBOR goes away? And Mariya will talk through about what we're seeing in terms of having hundreds of lawyers, hopefully somewhere in a lower cost location who are US qualified, turning the pages on every contract, trying to find out these answers. So the legal analysis is one of the biggest issues. And then you get down to things like, if I don't have LIBOR, what do I use instead? So David talked about how there's a spread between SOFR and LIBOR at the moment. But what is that spread? And that really breaks up into two things that now you have to solve for, because SOFR won't tell you as much as LIBOR currently does. One is, what is the credit spread between something that is effectively risk-free, which is treasury-linked lending, and AA credit, which is what bank borrowing costs are at the moment. That's component one. And then component two is that of duration, which is, if I used to look at LIBOR and look at my 30-day, 90-day, 120-day, and 1-year curve in LIBOR, and it used to tell me what was the cost of duration, what was the cost of borrowing out or of locking and funding out into the future. And that duration isn't available either in SOFR because it's an overnight rate, and all of the terms we're looking at are actually backwards looking, not forwards looking. So we can only look at history rather than into the future. So those are two problems that need to be incorporated into, oh, listen, if I have LIBOR in my contract and I'm just going to fail over to SOFR, I also need it to fail over to SOFR plus something, and how do I price that something? So those areas are where you have to say, where do I have LIBOR in my organization? Where do I have things that I've promised to investors? Where do I have something in my investment thesis that involves floating rates? Where do I have in my own borrowing from my banks when I'm looking at the funding in my funds, what there is floating rate as well? How am I going to address that? That's where is the exposure? And then what is the, well, what are we going to change instead? What do we use instead? We should really focus, though, on the last part, which is how do we report this and how do we communicate? Our investors, when they're doing due diligence on our funds, the first thing they're going to be adding now to due diligence is, and what's your plan for LIBOR replacement? Our regulators are going to be asking us that as well. And David, I think I'll ask you that question to address that shortly. But you know, you're going to have a pretty robust questions coming from regulators, either from the Fed or the SEC, depending on who regulates you. And then the last part is, how do we tell our stakeholders and our customers what we're doing about LIBOR? And there's a lot of conversation about conduct risk, which is, if we're in the power position and we do anything that disadvantages our clients, then our regulators are going to say, well, why would you do that? You've got an obligation to effectively make sure they're whole. So in reality, you only have downside vis-a-vis relationships with your clients. So this is a big area where at the moment, the industry is grappling with, okay, we're going to have to start communicating our plans to people. We better have robust plans. And that's where the consulting industry is probably going to be a big part of helping out, because whether it's banks or whether it's asset managers, no one's really got as much bandwidth as they used to have post-COVID to be able to put robust plans and documentation together, as well as have that open to examination. When you look instead to, well, whom should we involve in this conversation? This is a banking analogy, which is slightly relevant, or, you know, maybe needs to be flexed a little bit in the asset management approach. But you have in the center there that central project team who manage the 4 stages of this project, which is, let's get the governance set up, let's do this impact analysis, let's determine what our transition plan is, then implement it, and let's manage our stakeholders. And you can see you have the central team. And when we're talking to the people who are running projects at the moment, they say, oh, we're fine. We've got nothing to worry about. We've told the business units to go and assess their risk and they'll come back to us. So at the central level, getting a project stood up is something that most consultants can help you with, but everyone's kind of has that under control. It's at that next level down where you're looking at the business unit level, and the business units need to analyze, usually led by their COO, analyze, well, where is our risk and what are we going to do about it? That's where we're starting to see a few more pain points, because there isn't necessarily either the bandwidth or the expertise to be able to answer every question. But you tend to have this matrix structure that we've outlined here, where you have each business unit in the vertical lines, and in the horizontal lines, each functional area across those business units kind of needs to be a separate subgroup that reports up into the core in the center.
So David, I think, you know, the next, I mean, you mentioned here the regulators, right? And I think we want to, or Michael, you referenced the regulators. I think I want to move to that question on what the regulators are asking for, since obviously you can't have this conversation without thinking about the regulators, as Michael alluded to.
Sure. So in my current role, I spend a lot of time with asset managers. Although I had worked for a bank and a large banking and derivatives operation for a long time, it's asset managers right now who are the focus of this transition, because they're the ones with a lot of individual heavy lifting to do. And as Michael said, the conduct risk, because the asset managers, they look different than they did 10 and 15 years ago. So now there are two principal regulators, the Fed for the banks and the SEC, for asset managers, but they'll operate through the OCIE, the Office of Compliance, Investigations, and Exams. And OC will come in now. And in fact, at the end of 2019, so pre-COVID, they alerted the industry that this was going to be a big topic. They put it on the priority list. They published it in December. Well, they followed through despite COVID or anything else. In June, they came out and said, we're going to call you up and we'd like to talk about your LIBOR plans. And by the way, here are the 20 questions that we're going to be asking you. So in June, they published, and it wasn't just the metaphorical 20 questions, it was actually 20 questions. And there are 20 questions that any hedge fund and asset manager can go through and put together. It will be informed by your plan. And when Michael talks about planning, I entirely agree. The plan becomes this central repository of information around your organization, and from it grows, all right, how do I talk to LPs or investors? How do I talk to borrowers? How do I talk to my vendors who are supplying systems? How do I talk to the regulators? And how do I talk to my board about what we're doing? So that plan informs all of these other conversations. There's a quote, I think, by Eisenhower, who said something like, plans are not important, but planning certainly is. And the reason he said that is that when you get into the heat of battle, right, that plan may not work out the way you expected, but having that organized all of your information around this topic and having it available and having your organization fully alerted, that becomes critical, especially now that we're really in the last 6, 8, 10, 12 months at most of this process. And actions will come fast and furious, and they already have started in October. But the regulators then said, okay, we recognize that the plans are important and planning itself is important. So we'd like to come in and inspect what you did. My sense is that they honestly don't want to censure anyone or have fines or other outcomes. They just really want to make sure the industry gets on board. And we've been fortunate enough to have some of our clients go through those inspections. And I was surprised to find that the SEC, in fact, the first questions that they asked in the face-to-face were absolutely about governance. They said, who in your organization, how high, who's paying attention? And they said, can you name all the people and how they're related to the top of the organization? They want to know that this is embedded. And I'll use the phrase, just like a bank would. So banks have these highly structured change management organizations. And the SEC is asking for organizations that are asset managers to have a very similar concept. It doesn't have to look the same, doesn't have to be the same scale, but they'd like it to have those same concepts embedded so that the SEC knows that at senior levels in the organization, they're paying attention to, am I treating my borrower right when I go and renegotiate my contract, right? Am I telling my LPs that, in fact, we're gonna have to spend a lot of time and energy on this problem going forward? And one of the questions they asked in the 20 questions is, have you evaluated the risk from the perspective of each investor? Which is a little bit different. A bank looks at it sort of at a holistic and high level across all of its exposures. But the SEC said, no, take a look at each of your customers. They might have a chunk of risk that is either outsized or one direction where your overall portfolio doesn't have it. So they said they want you to look at individual investors' risks. So they're very much stressing through these questions the fiduciary obligations, the fair dealing obligations, and the sort of the higher level obligations of an asset manager while they're pressing on making sure that organizations are prepared for this cessation.
Thank you, David. And I'll stick with you, I guess you, David, and Mariya. You know, obviously we don't like this process to go as smoothly as possible, but there are always pain points, right? So why don't we talk a little bit about some of the pain points that companies are seeing as they go through this process?
Well, I'd really like to give you good news, but I'm gonna leave that to Mariya. Let me give you the tougher news first.
Right.
This is the tougher news. The ARC has put out timelines for different asset classes. And now these are best practice suggestions, but these are other suggestions from people leading in the field and the regulators and everyone else who understands the complexities of what these transitions are about. If I just look at the top one for a second, the blue bar is the date by which you should have hardwired fallback, or in other words, you should have in your documents the description of what happens when LIBOR goes away, and it should say SOFR plus some kind of adjustment. So hardwired fallback for floating rate notes, in fact, was supposed to be in June of this year, and it was actually achieved well before that. The vendors were ready for notes, and when I say notes, the calculations and payment mechanics of notes well before June. And in fact, there's about 800 floating rate notes that actually pay on SOFR right now. So the floating rate note market got well ahead of this. The red bar represents ARC's recommendation for when there should be no more LIBOR-based deals. And in fact, you can see that that's 8 weeks away, 9 weeks away now, right? Mm-hmm. So in 9 weeks, you should no longer see a corporate FRN or a general unsecured FRN with a LIBOR reference. They should only have SOFR references. So for that market, LIBOR went away this year. That's one way to look at it. If you look at the business loan market, then they have a different calendar. At the end of September, they were supposed to also have hardwired fallback in their deals. And that's where it says, if you can't find LIBOR, go immediately to SOFR or one of its term variants. And that language only started appearing in October. It's probably in a dozen deals out there circulating in the market. I'm not sure that all of the vendors that handle loan agreements and loan cash flows are actually ready. They were supposed to have been ready by the end of September. Not sure they're there. So you've got some pain points that are developing in these kind of, and I won't call it an accelerated schedule, but it's a prudent schedule to be ready for that ultimate cessation. You then see in this business loan section a really long space of white. And that white is between here and June 30th of next year. And so for the loan market, that's the day when you're not supposed to have a LIBOR reference anymore. And in fact, you should have SOFR-based loans only. No fallbacks, no LIBOR references, new loan issuance, and should just say SOFR plus spread. So that's June 30th, which is something like 8 months from now. So for the loan market, LIBOR goes away in new issue in 8 months. In the white space, the obligation for every business loan is to repaper, to amend, such that they have language that says what happens when LIBOR goes away. So if I restate that, every loan, every business loan out there has to be amended and repapered between now and next June to include some hardwired fallback language so that there is no uncertainty on the day LIBOR goes away. Every loan out there. That's a pain point.
Thanks, Dave. I guess, Mariya, now we'll go to the good news, right? So that's the bad news. We'll talk data and contracts, and why don't you kind of walk us through that and some pain points on that end and some solutions, more importantly.
Thanks, Alex. So if I can add on to what David was saying, and Michael mentioned it too, right? So the number one problem that we are seeing when we are talking about the timelines we just saw in the previous slide is the sheer volume of contracts to be processed. This is a massive exercise. It's very time consuming and expensive. And I think as Michael mentioned earlier, it's mostly done manually, and many of the large institutions have shipped this job somewhere offshore. So that is okay. However, it does introduce some challenges with respect to introducing human error, or how do we ensure compliance, et cetera, et cetera. So the question to really ask there is, because of the volume of contracts, how do you ensure that you have identified all contracts that are LIBOR impacted? That's number one. Number two, if that is done, how do you ensure that all the LIBOR references within these contracts are identified? So from a number one problem, just summarizing the volume of the contracts, that's one. Number two, right? And again, David mentioned about the timelines. So with just about maybe just a year left, it's important to think about what the end game is. So how are we going to remediate all these contracts in time? It's important to think about how agile and what is the process discipline needed to find the replacement rates, you have to do client outreaches in time, and also create amendments, right? So how are we going to get all this done within less than a year? So if we say those are the problems, it's important to talk about some solutions too. So if I can spend another minute on what the solutions out there, right? And our recommendation, we've been talking to all the clients out there, is to look for technology solutions and tools to help in this journey. Look for tools that is not trying to automate it end to end or trying to automate the process, but try to augment the human expertise and experience with tools that can help you increase the productivity and efficiencies. So when we talk about tools, there are a few things that you should focus on, right? So a tool should be able to easily identify LIBOR impacted contracts. So what does it mean by identify LIBOR impacted contracts? It's not looking for the keyword LIBOR. It's not the standard OCR technology that will look for keywords. It's tools that may have AI or machine learning built in that can help you understand the LIBOR references. Understand if there are fallback language provisions in the contract, and recommend to you, hey, this contract has a LIBOR impact. There are tools like that out there in the market today. The second point when you're looking for tools is to look for tools that can actually incorporate the fallback language as published by the ARC or the ISTA. I know David talked about it in detail, but the ability to incorporate the fallback language into a contract when it needs to be amended, it's important. The third thing to look for in a tool, it's important that the tool should be able to maintain the document lineage. That's going to be another important aspect. When you make all these amendments to the contract, you have to have the ability to link the amended contract to the original contract. And finally, if I say look for a tool that can help you create the actual amendment itself, right? So these are the 4 things to look for in a tool. And I think the most important aspect is when you look for a tool or a solution out there, can this tool be deployed on-prem or on cloud? And that's important because data privacy is key. And look for tools that can do either or both, depending on your needs. So if I were to summarize, what we have learned from our clients is that institutions should look at LIBOR transition as an opportunity to digitize your organization. This is an opportunity for you to convert all your unstructured data out there into structured information, structured data, and it may be able to help you with future needs coming post December 2021.
Thank you, Mariya. And I guess as we're kind of nearing the end here, want to shift to Michael. And I don't think we could have a webinar and not talk about COVID, right? Given significant impact it's had more broadly. So first, Michael, if you have any comments regarding pain points, anything you want to add, but obviously also, talk to us about how COVID maybe has impacted, this process.
Yeah, so COVID has impacted everything in the financial industry, right? I think what happened post-COVID to start off was we all focused on how do we keep the lights on and how do we maintain our business when we're not working from our offices, and how do we keep our staff safe? I think the whole industry responded probably better than everybody expected to that. Between, say, March and a couple of months ago, everything else got put on hold because you got to make sure the lights are on. What that did, though, was it kind of burned up 8 or 9 months of project time available to focus on LIBOR. So as that pushed and concertinaed all of the work to do, into the second half of this year and the first half of next year, then people start saying, well, okay, but the deadline will just get delayed, right? That's what should happen. The thing I would ask everybody in this room to take away, if you hear nothing else, is that there's almost no regulatory appetite for changing those deadlines. And the reason is because the Financial Conduct Authority have already said, listen, this is the extended deadline. You've had lots of time already. They're not talking to the asset management industry when they say that. They're talking to the banking industry. And so they're really saying to the banks, it's on you to catch up and get this done. That's number one. And then number two is in the US, there's an expectation on behalf of the Fed that banks are ready and that everybody on the sell side and everybody on the domestic banking side is done. Everyone internationally, that's kind of not their problem. So much as, we'd all like to think there's probably a delay here, I wouldn't count on it. And that's the problem. We can't count on it. And so as a result, then you have to say, wow, all that work has concentrated. And I have one client who summed this up in a way that said, well, you consultants, this is fantastic, right? This is the biggest gift since SOX 404 or CCAR. Because no one's got the bandwidth to build all these things. And in the asset management industry in particular, when you think about the impact on your legal teams, most of us run legal teams of 1 or 2 people, as few as possible, and then you just outsource everything else to your advisors. If every contract in finance needs to be turned, you need to turn the pages. I don't think there's enough lawyers anywhere in the world to do that. So as a result, then we're focused on, wow, we're going to have to do something a bit faster, either to check all these contracts in the first line or to review all the contracts that have been checked and give us a confidence score. So there's so much out there left to do. There's so many corners to turn over. You only want to focus on the big things rather than everything. But what you can't afford to be is surprised, and you can't afford to be caught out in a scenario where you have to explain to your regulators or to your LPs or to your other investors that, hey, we were caught out by this. Because, let's face it, if we're on this call, we're expected to be the smartest people in the room. So being caught out by something that we knew was coming is not a way to get that message across.
Okay. Thank you. Thank you, Michael. I guess one final question, actually, we got through the Q&A to you, David. There was a question regarding Ameribor, which has a credit component, and whether you see that as a viable alternative reference rate. You want to share your thoughts on that?
Yeah. So we knew from the beginning when we talked about an alternative rate that it had to be a couple of things. It had to be IOSCO compliant. It had to have general recognition and broad usage in the market to be to really be a standard. And we also knew that organizations like FASB and others had to adopt their standards based on its benchmark qualifications. So when you think about a thing which is a benchmark, it has other benefits that go along with it. So the answer from the ARC, from a lot of people from the Fed is, hey, Ameribor is great. If Ameribor recognizes your cost of funds uniquely well and gives you a hedging market economically, absolutely use it. It's not a benchmark though. And so what you're going to have to end up doing is observing the basis between Ameribor and SOFR. And if the Fed has its way, they would ask you to capitalize that basis. In fact, there was a paper yesterday that talked about the amount of extra capital that this transition is going to cost the banking industry. So Ameribor is a fine rate. It represents a certain market and it has a cash exchange that goes along with it. Absolutely terrific. But it's not a benchmark, and it means that you're going to have to observe and hedge that basis for all of your regulatory, for your reporting, your capital, all of the places that you need benchmark qualifications around the material, the financial material that you deliver. So great rate, but it isn't in of itself a replacement for a benchmark. Yeah.
All right. Thank you, David. Sorry to interrupt you there. I know we're nearing the end, but I wanted to give everyone an opportunity to just maybe give some final comments. Anything that you want to share, David, Michael, Mariya? We'll start with you, David, since you're on my screen.
Yeah, my quick one is use this as an opportunity to do something good in your organization. You're going to have to fix all the problems. Like Mariya said, use it to turn your contracts into structured data. Use it to reevaluate the way your systems work. Use it as an opportunity to approach your clients. Use it as a branding opportunity to say in the market, we're ahead of this thing. There will be winners and losers. You can choose which one you want to be.
Thank you, David. Michael?
My advice is to not wait. I think we've all come out from COVID. Now's the time to start addressing these things. And while you've got your project set up and it's all ready to go, start looking for the things that you haven't anticipated yet. And the answer to regulators probably doesn't start with, well, we're all fine. There needs to be a way of showing not just that we are fine, but that how are we fine? And just be ready for that conversation with your LPs and with your investors as well.
Thank you, Michael. Mariya?
Thank you all. And I think my last 30 seconds comment or 2 seconds comment would be, do not wait. I agree. And you don't have to do it all manually. There are so many tools out there. Technology can help do this and make our lives much easier. So leverage that.
Thank you, Mariya. Well, I just want to take this opportunity to thank all of the panelists. Just an incredible job. And I want to thank everyone for attending today's webinar. Now I'm just going to pass this back over to Mitch for some closing remarks. Mitch?
Wonderful. Thank you very much, Alex, for moderating. This is a very important program. Thank you for bringing it to the HFA and to our members. Mariya, David, Michael, outstanding work. And I want to reiterate what all of you have said. Now is the time to get to work if you haven't already. And we will be circulating a thank you email to you and all the attendees along with a webinar replay. And it will include contact data for our speakers and sponsor. So please take the opportunity to do this right. And again, thank you for your participation. And thank you again, Citrin Cooperman.